Welcome back. In a recent video, I talked about country indices like the S&P TSX Composite Index in Canada and the S&P 500 in the US. And in this video, I'm going to talk about index fund ETFs. So you can purchase all of these indices and the stocks included in them all in one basket. Now, there are many institutions that offer index ETFs out there. I'm just going to talk about maybe the four biggest ones that are available to Canadians right now. I'm not promoting any of these. I'm just using them as examples for this video. So I've put some in a spreadsheet here for us so that we can sort of see it in an organized manner here. And I've used iShares, BMO, Vanguard, because those are Canada's three largest ETF providers. And I've also introduced Horizons into this spreadsheet so that you can become familiar with the name. Horizons does some interesting things with their dividends and have provided some very tax efficient ETFs. So I just wanted you to be comfortable with that name. If you are unfamiliar with what an ETF is, I will have a video explaining all that sort of stuff as well. So in this spreadsheet, you can see there's four companies. The four companies have their TSX index ETF. The ticker symbols are there beside them. So iShares has XIC, BMO has the ZCN, and Vanguard has the VCN, and Horizons has the HXCN. And I've got the name of the ETF there beside it, and then the MER there as well. The MER is the management expense ratio. They are much lower than mutual funds. If you've watched my videos, you could see that those mutual funds could be well over to almost 3% at some times. A management expense ratio of 0.06% means that for every $10,000 you invest, you're paying $6 per year. And then you can see the holdings, and the holdings are very similar. XIC and ZCN hold almost the exact same amount of stocks in their portfolio. That's because they follow the S&P TSX, and Vanguard decided to do something a little different. They decided to follow the FTSE Canada All Cap Index. FTSE stands for the Financial Times Stock Exchange. So that's just a different index used in the financial world, and two of them happen to use S&P, the Standard & Poor's index, and Vanguard decided to use the FTSE. And you can see for the United States, the S&P 500 index ETFs, iShares has their XUS, BMO has ZSP, Vanguard VFV, and Horizons HXS. The MERs, again, are very similar. The holdings are very similar as well because it just follows the S&P 500. You'll notice that the XUS only has one holding, and if you dig deeper into that one holding is IVV, which is iShares' American version of the S&P 500 index ETF. So this ETF holds an American ETF, and there's some tax consequences for doing that rather than holding all of the stocks singularly, but essentially it doesn't make too big of a difference. And then for the international market index ETFs, you can see that there's XEF, VIU, and HXDM. The iShares follows the MSCI. The MSCI stands for Morgan Stanley Capital International, and it's just another company that creates indices. EAFE, the EAFE, stands for Europe, Asia, and Far East. And again, Vanguard decided to follow the FTSE. Really, the difference there is that the FTSE International Index includes a lot more Asian companies. So for instance, there's a lot more South Korean stocks in the VIU than there is in the XEF, which doesn't include countries like South Korea. And you can see there's maybe 1,200 more stocks in there because of that fact. Now, one of the things that I've always liked about ETFs is how transparent they are. And you can see that in the Horizons, I couldn't find the specific number of holdings there. I'm not sure why they weren't very transparent with that, but I'm sure it's going to be very close to what the other ETFs are holding as well. So if you look at a fact sheet, for instance, in this case, the ZSP, the BMO S&P 500, again, very transparent. It shows everything there. You can download the ETF facts here. It shows you the management expense ratio, the distribution yield, which is essentially like the dividends. It shows you the performance compared to the benchmark, and the benchmark in this case was the S&P 500. And you can see how closely it follows the S&P 500 because that's essentially what they're trying to do. They're trying to follow what the S&P 500 has done. You can see long term how closely they've managed to be able to follow that. And there's a slight difference in there, and that difference will come from the management expense ratios, the fees that you're paying. Shows you all your holdings and all that sort of stuff here as well. I just wanted to show you how closely it is actually to the S&P 500 here as well. So you can see on the left is the index ETF fund that you would be buying, and on the right is the actual S&P 500 holdings as of the recording of this video. So you can see the number one holding in the ETF is Apple at 7.45% weighting, and you can see that that is basically the exact weighting of Apple in the S&P 500. And same with Microsoft and Amazon and Nvidia, and it just goes on and it just follows basically the exact index in the ETF as it is in the actual S&P 500. So what that means is if you put $10,000 into this ETF, into this one basket, $745 goes into Apple, $690 will go into Microsoft, $303 is going to Amazon, and so on. And there's someone doing that for you. You put in the $10,000 into this ETF, and somebody is distributing it basically into all of these different companies for you. And that's where that management expense ratio comes from. At that 0.06%, you should be happy to pay such a low fee for someone to do all that work behind the scenes. And generally, these ETFs are rebalanced every quarter. So every 3 months, they look at the S&P 500 again, rebalance it towards what they want, and leave it there for another 3 months and ensure that those percentages, those weightings are about the same for their index ETF as it is for the S&P 500. And here's an example of two TSX index ETF. The one on the left is the iShares XIC, and the one on the right is BMO ZCN. And you can see how closely they are to each other, Royal Bank is the top holding. One has 6.10% and one has 6.04%. Second is TD. One has it at 5.15, one has it at 5.09. And that's just because their rebalancing is slightly different. They might have different rules for it, but really, essentially, the two ETFs are identical to each other. So when I first started investing years and years ago, I did a whole bunch of research, and what I really liked was Dan Bartolotti's Canadian couch potato portfolio. And so what he basically said is take the equity portion of your portfolio and just distribute it evenly into the Canadian index ETF, a US index ETF, and an international index ETF. I wanted to be an all equity investor, so that just meant that 1/3 of my money would go into a Canadian ETF, 1/3 of my money would go into a US index ETF, and 1/3 of my money would go into an international ETF. It's important to note that a balanced portfolio, which is what a lot of advisors will recommend, is a 60-40 portfolio. So 60% equity and 40% bonds or fixed income. And so that would mean 60% of your equity portion would be broken up into 20% Canadian ETF, 20% US ETF, 20% international ETF, and then 40% would be some sort of bond ETF. That whole thing, that will be a video that's going to come later. I have changed my strategy a little bit. My portfolio has grown, so I'm looking to be more tax efficient as my portfolio continues to grow. So I've made some adjustments to it a little bit. I know when my boys started investing years ago, when they were about 7 years old, I gave them a very similar spreadsheet to this, and I just had them pick one Canadian index ETF, one US index ETF, and one international index ETF. It didn't matter which ones they choose from each of the choices, because again, looking at them, they're very, very similar, and I was confident that they wouldn't be making any mistakes if they chose any of them. It gave them a sense of ownership. They created their own portfolio, so they really enjoyed that. They didn't know what they were doing, but they really enjoyed doing that. And they've learned so much since they've been investing all these years. They're okay with the markets going up and markets going down now. They know that it's going to happen. They know that at some point they're going to lose 20% maybe of the portfolio, but over the long term, their portfolio is going to continue to grow and grow and grow. And if we wanted to build that portfolio, again, I'll just use Questrade's practice account, and I have a video on how to use that. But if you just type in the ticker symbol, I'm just going to use iShares because it is the largest company. So XIC for our Canadian portion, So it shows that we can, let's just say we put $10,000 into each of these. Let's just break this up into 1/3, 1/3, 1/3. So 312 shares of XIC, 137 shares of XUS, and 292 shares of XEF. And there we have it. We just bought 3 index ETFs, a Canadian, a US, and an international index ETF. We've just purchased over 3,000 companies around the world, and it's that easy to invest in the index or investing in the market. If you've enjoyed this video and would like to stay informed of some of my other ones, please subscribe below. And as always, have a wonderful day.